Hello there and welcome once again. In this video, we will be talking about cryptocurrencies. There is a lot of information to unpack here, so please grab a notebook and a pen and make some notes. Try as much as possible to do away with any distraction, alright? And go over this video so that you can understand everything regarding cryptocurrencies before you get started. This is the ultimate step-by-step guide you need before you start trading or investing in cryptocurrencies. I am not a financial advisor. This is not any form of financial advice. I will encourage you to do your due diligence or make your own research before making any investment decisions. Everything I'll talk about here is my own opinion from my own research and experience. Alright, so without much ado, let's get started. We will look at what is cryptocurrency. How does it work? We will look at the blockchain. Popular cryptocurrencies. Two categories of cryptocurrencies. Bitcoin. Altcoins, stablecoins, coin market cap, crypto wallet, crypto exchange, cryptocurrency mining, proof of work versus proof of stake validators. What determines the price of a crypto? The risk of investing in cryptocurrencies, crypto scams, due diligence. How to analyze a crypto white paper, the crypto news source, initial coin offerings, strategies, dollar cost averaging, how to get started. Alright, let's get started. Bitcoin became the first decentralized cryptocurrency back in 2009, and ever since, interest in digital currencies has exploded. According to the coinmarketcap.com, there are over 8,000 cryptocurrencies currently trading around the world, with a combined market cap of about $2.24 trillion. In the last decade, Bitcoin has grown from $1 per coin to $60,000 plus per coin. The explosion in price has attracted a lot of investors and media interest into the ecosystem. Cryptocurrencies are becoming popular as the whole crypto space is still in its early stage and beginning to gain mainstream status. What makes it enticing for people is the fact that it is a decentralized currency that the government cannot control. Cryptocurrencies are starting to get more and more backing from financial institutions as more financial giants are showing support and accepting cryptos as payment. Crypto is pretty mainstream, but not as mainstream as it could be. We are still early and there are so much more opportunities, especially with the blockchain technology. Now let's get into details. What is cryptocurrency? A cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it impossible to tamper with, duplicate, or double spend. Crypto comes from the word cryptography, which is the act of writing and solving codes, whereas the currency is money, and money comes in any form accepted by the people as a means of exchange. In some countries, cryptocurrency is seen as a currency, but in the US, it is seen as a property and is therefore taxed as such. Investors in crypto will need to pay capital gains taxes regardless of where they bought their crypto. So once you are in the US or you're a US citizen and you want to sell your cryptocurrencies, remember you're going to pay tax. All right. And then there's a short-term capital gain tax and then the long-term capital gain tax. And I understand that the long-term capital gain tax is a little cheaper than paying for a short-term capital gain tax. And the short-term capital gains tax is within a year or less, right? But even if it's a day more than a year, right, then you're going to pay for long-term capital gains tax, which is pretty cheaper. So try and know the difference and try and know when you are buying and selling your coins. All right, it depends on how long you have been holding your coins. How does this work? Cryptocurrencies work through distributed ledger technology, the blockchain, that serves as a public financial transaction database. Blockchain is a decentralized technology spread across many computers in different locations that manages and records transactions. Cryptocurrencies does not exist in physical form like the fiat or the paper money, right? And are not issued by central authority. So there are no third parties involved in cryptocurrency. Now, crypto networks are immutable. This means that it cannot be altered or deleted. Once a transaction is placed, it's gone. All right. Immutable transactions make it very difficult or impossible to manipulate data stored on the network. Now, centralized system. With a centralized system, transactions go through the central bank, which is a third party, or the central authority. All right. So if Romeo here wants to send Juliet some funds electronically, then the fund is going to go through the central authority or the bank. Now, with a decentralized system, the decentralized system means a direct payment to individual without a third party or central authority. And cryptocurrencies work peer-to-peer. So Romeo here can decide he wants to send Julie cryptocurrencies and the money is going to go straight to Julie without a third party. So this is how cryptocurrencies work. When I decide I want to send you H1Z coin or Bitcoin or Ethereum coin, it is not going to go through the bank or a central authority. Then we also have the distributed network. So with a distributed network system, transactions are processed over a distributed network without a third party or centralized authority. Bitcoin or cryptocurrencies use the decentralized system plus the distributed network system. Now we understand that with a decentralized, you're able to send funds to your peer without it going through the central bank. And then with a distributed network system, it's just a network that is processing the information, the data, the coins that you are sending, right? Just so that everybody on this distributed network system is aware of what is going on, right? I know what transaction everyone else is doing once I'm on the system. And that is how open the cryptocurrency system is. Okay, let's look at the blockchain. The blockchain is a digital distributed decentralized technology spread across many computers that manages and records transactions. Blockchain is also the technology that enables the existence of cryptocurrency, among other things. So it means without blockchain, cryptocurrencies cannot exist. So blockchain is like the backbone, the pillar, the foundation, the skeleton, everything of the cryptocurrency. And Cryptocurrency is not the only thing that can be stored on the blockchain. We'll be looking at that into details later. All right. Cryptocurrency is not the only thing. So I keep telling people that cryptocurrency is just one of the many benefits that is going to come from blockchain. And already we have NFTs and the dApps and etc. We are going to go into details on this. A blockchain is a continuously growing list of records called blocks, which are linked and secured by cryptography. When new data comes in, it is entered into a fresh block. Once the block is filled with data, it is chained onto the previous block, which makes the data chain together in a chronological order. Now, different types of information can be stored on a blockchain, but the most commonly used so far has been a ledger for transactions. Blockchain is used in a decentralized way so that no single person or group has control. Rather, all users collectively retain control. This is real democracy. Now, how does a transaction get into the blockchain? Okay, so a transaction is requested and authenticated is the first step. Then a block representing the transaction is created. The block is sent to every node, which is participant in the network. Nodes validate the transaction. Then the nodes receive a reward for proof of work, typically in cryptocurrencies. Now, the block is added to the existing blockchain. Now, the update is distributed across the network. So everybody gets the information, the nodes gets the information that yes, this has happened. Then the transaction is complete. So this is how the transaction process works on the blockchain system. All right, so what is the distributed ledger technology? A distributed ledger is a database that is consensually shared and synchronized across multiple sites, institutions, or geographies, accessible by multiple people. The distributed ledger is the same technology that is used by blockchain. Blockchain is basically a type of distributed ledger technology where transactions are recorded with an immutable cryptographic signature called a hash. Now, the properties of the distributed ledger technology. This technology is programmable. This technology is secure. All records are individually encrypted. Anonymous. The identity of participants is either anonymous or pseudonymous. Unanimous. All network participants agree to the validity of each transaction. Timestamp. A transaction timestamp is recorded on a block. Immutable. Any validated records are irreversible and cannot be changed. Distributed. All network participants have a copy of the ledger for complete transparency. Now, popular cryptocurrencies. So, example of cryptocurrencies are Bitcoin, Ethereum, the Binance coin, Tether, Solana, Cardano, USD coin, Ripple, Polkadot, Dogecoin, Avalanche, Shiba Inu. Now, all these are cryptocurrencies. However, you can see on the category side of it, that some are coins and some are tokens, right? Good, so we're going to explain that. Categories of cryptocurrency. We have the coin and then we have the token. The coin is a cryptocurrency that has its own blockchain. And then the token are cryptocurrencies that do not have their own blockchain but live on another blockchain. So the coins are Bitcoin, Ethereum, Binance Coin, Cardano, Solana. These are examples of coins. It means they have their own blockchain. However, Binance Coin used to be a token and then was upgraded. So it means that the tokens in this example can also be upgraded into coins. Once the company behind the project decide to build a blockchain, then this token will become a coin. Now, Bitcoin. So most of the time people were confused about what is cryptocurrency and what is Bitcoin. So cryptocurrency is the general name, and then Bitcoin is an example of a cryptocurrency, and we looked at the other examples as well. Now, what is Bitcoin? So Bitcoin is a cryptocurrency or a form of electronic money. Meanwhile, some investors consider it as a store of value. Yes, store of value. Bitcoin was created by an anonymous group or person that goes by the pseudonym Satoshi Nakamoto. So for now, all we know is Satoshi Nakamoto is the person who created Bitcoin. Bitcoin's white paper was published by Satoshi Nakamoto on October 31st, 2008. And then the first block was mined on January 3rd, 2009. And ever since, Bitcoin has been around. The Bitcoin creators wanted to eliminate the middleman, cancel interest fees, and make transactions transparent, to hack corruption, create organic network value, and cut fees. And this was their goal. According to Bitcoin.org, the official website of Bitcoin, it says that Bitcoin uses peer-to-peer technology to operate with no central authority or banks. Managing transactions and the issuing of Bitcoins is carried out collectively by the network. Bitcoin is open source. Its design is public. Nobody owns or controls Bitcoin, and everyone can take part. So this is coming from the official website, and it goes on to say Bitcoin is a fast peer-to-peer transactions, worldwide payments, and then low processing fees. Now there's competition among the cryptocurrencies where most of them are also trying to come up with an even faster transaction system and then a more lower transaction fees. This is the Bitcoin chart from TradingView. So we can see that on the 7th of February, which is some decade ago, BTC was trading at $1 per coin. Even in January, it was around 30 cents per coin. January 2011. And 10 years later, 10th November 2021, BTC traded around $69,000 per coin. $69,000 per coin. Now, this is simple. Just look at the chart, study the chart, do the maths. So, assuming you bought $100 worth of Bitcoin in February 2011 when the price was trading around $1 per coin, it means you have 100 BTC. Okay. And you left it and opened your wallet around November 2021 when it traded around $69,000. It simply means your 100 BTC from a decade ago was now worth $6.9 million. $100 now worth $6.9 million. I don't have to say much. You can do the maths. You might be thinking the price is too high. But yes, it was once high when it rose to 19,000 around December 2017. Bitcoin rose to almost 20K. And people thought it was high. But what happened? It went even higher. All right. Now, Bitcoin versus money. Bitcoin does not get one out because yes, it is digital. It's visible but untouchable. Like you can't feel it, you can't handle it. It's not like the paper money. Bitcoin has a 21 million BTC maximum supply. So once we hit 21 million, we are not going to go more than that. Bitcoin is infinitely divisible. So there's nothing like because the supply is cut, not everybody can have everybody can still have Bitcoin. Everybody all over the world can still have Bitcoin. All right. The value will just be doing the talking. So one Bitcoin could be around 1 million because a lot of investors want Bitcoin and it's been split into pieces. Now cannot be counterfeited. So the way we can have counterfeit fiat currency notes, we cannot have counterfeit cryptocurrency. Now, unless somebody is selling you a physical coin and call it Bitcoin. But now Bitcoin is digital and there cannot be a physical version of it because that is what the creators of Bitcoin or cryptocurrencies are trying to take away from the system to make it digital instead of physical. Bitcoin has no centralized authority, and this is one of the things that investors love about Bitcoin or cryptocurrencies. Now, let's look at money. So, when you come to money or fiat currencies, there is no inherent scarcity, unlimited supply. So, your government will continue to print out money every time they print money, So, there is no limited supply of fiat currency. Now, the fiat currency can be mismanaged and can be manipulated. All right. So, the central authority or government can decide that, all right, we think we want to do this to our currency or do that to our currency. And they have the control so they can manipulate it to whatever they want it to be. Yep. Now, Bitcoin Explorer. So another beautiful thing about Bitcoin is, or cryptocurrency is, it is open source and you can see the transactions that is going on. Right now, let's go to blockchain.com and check out the Bitcoin Explorer. All right, so here we are on the blockchain.com. We can go to the Explorer. Now here we scroll down and then view all transactions. So once you click on view all transactions, this is what is currently happening on Bitcoin. People buying and selling Bitcoins, all right? And you can see the ongoing transaction. Somebody just bought one BTC 1.7, and so you can see every transaction that is currently happening on BTC here. This is 290. That's $13 million. Yep. So this Bitcoin Explorer, you get to see what transactions that are currently happening on the network. So this is, I like to see the big ones, man. Then I go like, yo, man, who is that? The whales are at work. 393. That is $18 million. That is it. Crypto whales at work. All right, let's go. Altcoins. Altcoins simply means an alternative to Bitcoins. Tokens, cryptocurrencies, and other types of digital assets that are not Bitcoin are collectively known as alternative cryptocurrencies. This term is commonly used to describe coins and tokens created after Bitcoin. Altcoins often have underlying differences with Bitcoin. For example, Litecoin aims to process a block every 2.5 minutes rather than Bitcoin's 10 minutes, which allows Litecoin to confirm transactions faster than Bitcoin. Ethereum has smart contract functionality that allows decentralized applications to be run on its blockchain. Ethereum was the most used blockchain in 2020 according to Bloomberg News. In 2016, it had the largest following of any altcoin according to the New York Times. Alright, stablecoins. Stablecoins are cryptocurrencies designed to have a relatively stable price, typically through being pegged to a fiat currency, a commodity, or having its supply regulated by an algorithm. Stablecoins are subject to the same volatility and risk associated with the backing asset. So with fiat backed, their value is pegged to one or more currency. So most commonly is the United States dollar, the euro, or the Swiss franc in a fixed ratio. Example is the Binance USD, the Theta, the USD coin, Paxos, Pax dollar, the DAR, the True USD, and etc. Now let's go to CoinMarketCap. Alright, so now on coinmarketcap.com you can do a lot of things. So as a beginner into the cryptocurrency world, please make use of coinmarketcap.com. Alright, now here at least you get information on the cryptocurrencies, exchanges, NFTs, portfolio. Here you can create your portfolio. So once you click on portfolio, please be sure that you sign up or log in if you already have an account. Click on create portfolio. Now because I've not logged in on this window, it is asking me to do so. So you just try and enter your information to create the account, then you can proceed to create a portfolio. All right, you can track your crypto portfolio using the CoinMarketCap portfolio. All right, now let's go back to the main page. All right, so on the home page here you will see today's cryptocurrency price by market cap is at 2.25 trillion. All right, now when you scroll down, that's where you see like what's trending, and then biggest gainers is here. Now when you see the biggest gainers, does not mean you should go and buy the coin or token. So we'll be learning about the best strategy to trade or invest cryptos. All right, we'll be discussing that getting to the end of this video. If you see this here, it doesn't mean it is the coin you should buy. You have to do a due diligence, do your own research, and understand the coin you are trying to invest in. When you continue to scroll down, you're going to see the list of coins up to 100. Here are the top 100 coins. When you go on to the next page, you see up to 200. However, you're not going to buy all the coins. So if you're going to buy one or two or a maximum of 5 coins, you should get it in the top 100. So the first one is Bitcoin because of its market cap, not the price, because of its overall market cap. All right, that is why it's sitting at number 1. Then Ethereum is sitting at number 2, also because of its market cap. So these rankings are based on their market cap, with Binance Coin sitting at number 3. All right, followed by Theta, Solana, Cardano, USD Coin, Ripple, Terra, Polkadot, Avalanche, Doji, Shiba Inu, and they can change at any point in time, because recently Shiba Inu became number 3 and now it has gone back to number 13. Now once the market caps increase again, it will go up again. So we have Doji also at number 12. Doji also went up a bit but then has also dropped. All right, but it doesn't mean they are going to continue going down. You can see the chart is full of uptrends and downtrends, uptrends and downtrends, but we have the overall trend, all right, which is bullish for the whole cryptocurrency market. All right, listen, I'm going to talk about these coins individually in future videos, so make sure you have subscribed to this channel. We are just getting started. I'm going to tell you which coins I'm holding and why I'm holding those coins, how long I am holding these coins, and then that can help you filter down on why you are going to buy a certain coin, right? So please subscribe to the channel and turn up the notification bell so that you will get every information that I am going to share. All right, let's go on. Okay, so what is crypto wallet? Crypto wallets keep your private and or public keys safe and accessible, allowing you to send and receive cryptocurrencies. There are different types of crypto wallets, such as paper wallets, hardware wallets, and software wallets. And these are still categorized into two: hot wallet and then the cold wallet. So we're going to look at what is hot wallet and then what makes the cold wallet. A crypto wallet security depends on how the private key is stored. So how you store your private key is how safe your wallet is. Let me take a chill pill and tell you this. When you lose your private key, your crypto is gone. When someone, a bad guy, a scammer, or whoever gets your private key, then your crypto is gone. So please, you keep it safe, all right? So let's move on. Now, public keys or wallet address. This can be used to make transactions into your wallet. So it's safe to share with other people for them to make a transaction to your wallet. It is safe to share your public key, all right? Now, private key. Your private key is the set of numbers and letters that allows you to access your wallet. If you lose your private key, you have lost your wallet. So you should always have your private key written and kept safe. All right. Types of crypto wallets. The paper wallet falls in the category of cold storage because it's an offline wallet. Keys are written on a physical medium like paper. So it could be paper, card, plastic, or metal, right? Now, this, of course, is safer, but makes using your crypto harder because as digital money, it can only be used on the internet. Now, if you are a regular user of cryptocurrencies, then you don't really need the paper wallet because it's going to make it hard for you to use. You always have to try to log in and log out. But if you're a very long-term holder and you are holding huge sums, then this is best for you because you don't want to risk your hundreds of thousands of dollars, millions of dollars, billions of dollars on the software. This will depend on you, how much you're holding and how you want to protect your cryptos. Hardware wallet falls in the category of cold storage because it's also an offline wallet. So with this, the keys are stored on this thumb drive kind of device and only connected to a computer when you want to use your crypto. The idea is to try to balance security and convenience. All right, so that's the hardware wallet for you. Now, the software wallet. So, software wallet is in the category of hot wallet because it is always online. These are simple mobile apps, desktop programs, or browser extension that stores the keys and makes it easy for people to send, receive, and store crypto. Go for one that is protected by two-step encryption. All right, two-step encryption is where you have to log in with your password, which is what you know, and then a device like your mobile phone, something you have. So even if somebody gets your password, they don't have your device, or when they get access to your device, they don't know your password. All right, so make sure your wallet has two-step encryption. Now, popular crypto wallets. So here we have the hot wallet and then the cold wallet. And the cold wallet, you have Trezors and Ledger, Nano X, and Nano S. All right, then the hot wallet, we have Exodus, Electrum, Trust Wallet, Mycelium, Coinbase, blockchain wallet, and etc. There are other ones though. There are many of them, but these are just some few. All right. Now, crypto exchange. A cryptocurrency exchange is an online platform where users buy, sell, hold, and trade cryptocurrency. So a cryptocurrency exchange works similar to an online brokerage, as users can deposit fiat currency such as the dollar and use those funds to purchase cryptocurrency. Cryptocurrency exchanges act as an intermediary between a buyer and a seller and make money through commissions and transaction fees. A good crypto exchange makes it easy to buy and sell the cryptos as you wish, with low fees and robust security features. Some examples of crypto exchanges are Binance, Coinbase, FTX, Kraken, Crypto.com, Gemini, and etc. There are things you should look at when choosing a crypto exchange. So you don't just look at the fancy logo or popularity of the name, but you still do a due diligence and try to figure out why you are choosing a certain crypto exchange. Number one, you look at the safety. All crypto exchanges have the potential to be hacked. You should look for how likely is this going to happen, and then what protection do they have. So you have to investigate these on the exchange that you are hoping to work with or to trade on. All right. Now, their customer service. Is it easy to reach support in case of emergency? Is it easy to contact somebody in case you're having some challenges or in case you suspect something fishy about your account? That should be something that you should be concerned about. Transaction fees. Are the costs involved moderate or extremely high or high? All right. So you have to watch the transaction fee and see if it is okay with you. But remember, lower transaction fees doesn't always guarantee safety. So you have to consider a lot of other factors as I've mentioned. Now, the interface. Is their interface easy to use or user friendly? Yeah, you have to consider this factor because you are going to be doing a lot of things probably on their interface, and I believe you want to go for one that you'll be comfortable with. You don't want something too complicated and stuff like that. All right. Now, let's look at cryptocurrency mining. Cryptocurrency mining is the process where specialized computers, also known as nodes or mining rig, validates blockchain transactions for a specific crypto coin and in turn receive a mining reward for their computational effort. So these guys, those miners, these validators are the nodes that I mentioned earlier, and they are in charge of validation, right? And the computers behind the cryptography, right? This is also the process by which new units of cryptocurrencies are mined and introduced into the market. Example, Bitcoin. Mining is performed using sophisticated hardware that solves an extremely complex computational mathematical problem, also known as proof of work. Now, the first computer to find the solution to the problem is awarded the next block of Bitcoins and the process begins again. So when you have a mine, you have to make sure that there is no power cut or power outage on your mine. From this illustration on the right, you can see a mini mine. This is very little compared to what some people have, a whole warehouse, but it's illegal in some countries because of the rate of power consumption. All right. So you have to be sure that you can set up a mine in your country before you do so. Now, to set up a mining rig, you need either a GPU, graphics processing unit, or an application specific integrated circuit, ASIC. So You need any of these devices to build the computer or to build your mine, all right? And then you can have your mine running. So watch out for my video on mining, or you check out the link. All right. Proof of work versus proof of stake. Proof of work is a decentralized consensus mechanism that requires members of a network to expend effort solving an arbitrary mathematical puzzle to prevent anybody from gaming the system. Due to proof of work, Bitcoin and other cryptocurrency transactions can be processed peer-to-peer in a secured manner without the need for a third party. So this is the system behind the whole Bitcoin being secure. Proof of stake. The proof of stake mechanism randomly selects validators to validate block transactions and requires specific amount of cryptocurrency to be offered up as collateral, called staking. And proof of stake is an alternative to proof of work, all right? Proof of stake reduces the amount of computational work needed to verify blocks. Coin owners with staked coins become validators. And Ethereum currently is proof of work, but are working on migrating to proof of stake. Okay, but Bitcoin has no plans of migrating to proof of stake yet. All right, but in future announcements on this channel, I will tell you which coins are proof of stake, proof of work, and so why they are the future. Okay, so proof of work versus proof of stake. Validating nodes. The proof of work uses miners, whereas the proof of stake uses validators. Energy consumption. So proof of work has a very high energy consumption, and then proof of stake is comparatively low. With regards to rewards, the proof of work system earns block rewards, whereas the proof of stake earns transaction fees. Are these systems hackable? Something like that, but how? So with proof of work, hacker will need 51% computational power. Okay, 51% computational power means that you should have 51% of the existing mining rigs all over the world. What are you hacking for? Money. But the amount of money you will put in building the 51% computational power is more than what you are even targeting to make. So why would you go and risk something that has not been proven? It might not work. Okay, let's just say it will work. Go and try. Now with the proof of stake, hacker will need a 51% stake. That is another huge money. And even that, will it be possible? All right, now the safety. Yeah, so proof of work says, yes, I'm hackable because I've told you you need 51% computational power, but still not possible. And then proof of stake says, well, you might think I'm hackable, but it's even harder than proof of work. This is why I've come to trust this system. Since 2009, hackers have been trying to hack the system, and they themselves know they can't. So they find another way to hack anything, which are like the exchanges or the wallet and stuff. What determines the price of a crypto? As with any asset, value is determined by supply and demand. We've learned from our economics class that when demand falls, it means supply rises and then price falls. And then when demand rises, supply falls and then price goes up. The supply of an asset plays an important role in determining its price. A scarce asset is more likely to have high prices, whereas one that is available in abundance will have lower prices. So this, if you don't know anything about economics, at least you were here during the pandemic, the coronavirus pandemic, and then you saw how the prices of the nose mask and hand sanitizers were hiked simply because there was high demand and then less supply. That is a typical example to supply and demand of any stock, any cryptocurrency, or any currency, any asset at all. Supply and demand is what determines the price. Bitcoin, for instance, has also become popular in countries with high inflation and devalued currencies such as Venezuela, Zimbabwe, and etc. Other factors include the brand, utility, and importance. Bitcoin is the most important cryptocurrency because we know it's the number one cryptocurrency, the first cryptocurrency to be mined. Another brand-based assets can be Doji. When you get people like Elon Musk tweeting about it and then the price is reacting. Elon Musk is the world's richest person, so people will pay attention to his tweet. Example for an utility-based crypto is Ethereum. The Ethereum blockchain is a hub for many crypto tokens. Investor demand for the cryptocurrency has also risen with increased media coverage. So the hype, the publicity also draws the attention of investors to the cryptocurrency. So you also pay attention to these factors, driving the price of the cryptocurrency. The risk of investing in cryptocurrency. Yes, in everything there is a risk. So you want to know the risk of what you are getting yourself into before you take the step. So let's look at some risk of investing in cryptocurrencies. Crypto is extremely volatile and still very speculative, hence involving a high risk of loss. This is a very volatile market. So if you decide you want to day trade it, remember that losing will be inevitable, and you have to really know how to day trade to be able to stay successful in that market. Crypto scams. Yes, there are lots of crypto scams, and we're going to talk about some of them. You have to be careful. You have to do a due diligence, and then you have to watch out, all right, for these crypto scams so you don't fall victim to it. I'm going to discuss some here, and we will discuss more in subsequent videos later, all right? Not a legal tender. Yes, cryptocurrency is widely still not a legal tender because we need the government to really approve. You should be careful how much you are even investing in case the government all over the world decide that, okay, let's all stop crypto together. But how are they going to stop crypto? To stop crypto, you have to stop the internet. And will any government stop the internet? Because everything is now evolving around the internet, with the banking system, with data, web, everything that is going on is internet. So even though it's not a legal tender, I don't see any government really rising hard like China is doing against cryptocurrency. Cryptocurrency is the future, man. Fake crypto exchange. So you have to watch out for fake crypto exchange as well, okay? So that you don't get swindled of your hard-earned money. Okay, so there is blackmailing. They be using cryptocurrency to blackmail people. All right, so somebody will say, hey, if you don't send, okay, they kidnap someone, and then they go like, yo man, if you don't send crypto to this address, because crypto is anonymous, you can do a transaction and nobody know who is behind the wallet, right? Yeah, so bad people use it to blackmail, and this is why people think crypto is a good thing. But crypto is not a bad thing. It's just bad people taking advantage to disadvantage other people. Phishing. So be careful when you receive an email and it says that, hey, I'm Donald Trump, I want to send you cryptocurrency, but if you first send $1,000 crypto to this address so that I will send you, please, that is a scam. You have to be careful of this phishing emails. Some too will say click this link and do that, and then they're going to get access to your computer. Be careful which link you are clicking in your email if you are not expecting any email from anybody. Now we have smishing, which comes through SMS. Smishing is also used to get access into your phone, your computer device, and etc. So smishing will send you a code or a link, and then they will hack your device. So please, if you don't know who is sending you whatever link, be careful when you are running your crypto on your phone. Okay. Now, Vision. So Vision is a phone call. So you get a phone call and you say, hello, I am Elon Musk. I want to send you crypto. So first of all, I want you to confirm your password. Please be careful. So I'm going to share another video on how you can get scammed. You got to watch that video so that you remain ahead of them. All right. So watch out for the next video. Crypto scams, Ponzi scams or Ponzi schemes. These are high yield investment programs which promises you higher interest rates such as 1%, 2%, 3%, even 5% return on investment daily. They duck and emerge under different names in order to protect themselves, so you don't see them. So when they run a certain program for like 6 months or 3 months, then they disappear. They take away your money and then they come again newly branded, and then they start doing their publicity again. Be careful of this high yield investment scams. I was a victim in 2018, and so I know how they work very, very well. The only thing I knew was I should not invest what I can't afford to lose. I was careful about how much I was risking. I knew that it was very risky because it had a high reward. Even if you give me another one which is 100% returns a day, I'm not going to do it. I've learned my lessons and I know how to make money now myself and not trust in some Ponzi scheme or scam investments program. All right. Now, these schemes tell you to deposit money using a cryptocurrency like Bitcoin. You make the deposits and they also be paying you your returns in Bitcoins, right? And then you think that, oh, it's a good thing. Why not? Let's do it. Let's do it. Let's do it. By the time you realize, you're going to put all your hard-earned money, because they're going to build trust over time, because they're actually going to be paying you. But once they realize that they've met their threshold, maybe some millions of dollars, then they disappear. All right. So you have to be careful. Now, Bitcoin mining scam. These companies will offer to mine outrageous amounts of Bitcoins for you, and you will have to pay them some money. Somebody can set up a crypto mining rig and then set up a website and tell you join their website, sign up, and then they're going to mine and you're going to earn some return on your investment, right? You have to be careful with these guys too, because it's not easy to mine, and plus, you know, especially when the return on investment is that high, and then you have to be very, very careful. Okay. Now, Bitcoin exchange scams. Now, these exchange scams tend to offer features that the typical Bitcoin wallets don't offer. Example is they tell you they accept PayPal and then credit cards processing, or they have better rates. Now, Bitcoin scam wallets or Bitcoin wallets scam. With the experience I had in 2018, this company went ahead to set up a wallet. So instead of now we using the blockchain wallet, they tell you that when you make withdrawal, send it to their own wallet. All right. So they created a wallet that was what they wanted us to use, but it was on a web, and it means that when you make your earnings, you withdraw to your wallet. So that's also brought some level of trust in the company. And so people were like, yo, man, these guys are serious. Oh, this is the future. Until one day the wallet did not work again. Yo, I lost a lot of money, but I got to learn more. And yeah, it's one of those things. And there are also scammers trying to get information that gives them access to your digital wallet or other types of private information such as security codes. So be careful. Okay, so before you invest, as mentioned earlier, there are more than 8,000 digital currencies available as of now. While most of these cryptocurrencies are attempting to innovate and seek a niche in the crowded marketplace, others are simply looking to make quick money off inexperienced investors. How can an investor take advantage of the incredible opportunities within the digital currency space while at the same time protect themselves from bad actors, aka scammers? The only answer is do your due diligence. All right, this takes us to our next topic: due diligence. Due diligence is an investigation, audit, or review of a business or an asset that you are planning of investing in. In the financial world, due diligence requires a thorough examination before investing. You really have to understand and know what you are getting your money into, the risk involved, how you can make money, how you can lose money before you go in. Always take the time to fully understand anything you are investing your money into. I encourage you to do your own research. Always do your own research. Now, how to analyze a crypto. So there are so many ways of killing a cat, right? But one of the ways that I'll teach you is just make a list of what you are looking for. The same way in Forex, you have a checklist before you take a trade. Here too, you need to have a checklist of things you are looking for before you decide to invest in a certain coin. And this is simple. Number one is find the purpose of the project. All right. The crypto shouldn't only promise to solve some problem. It should promise to solve that problem in a way that makes sense. Number two, review the white paper. Blockchain projects are typically laid out in a white paper, a publicly available document detailing the blockchain's mission and how it works. Where to buy and use the cryptocurrency is also very important. Like you buy a cryptocurrency and then you can only buy it from the website to some wallet, and then you can't sell it anywhere. Yes, it's very important. Is the crypto listed on an exchange? It's very, very important. So because exchanges require coins to jump through different hoops to get listed. So it's not easy to get a coin listed on Binance, Coinbase, Gemini, and etc. All right, you'll be looking for coins that have been listed for security, and be sure that okay, Binance kind of have some information, or Coinbase have got information about these coins. That is why they are listing them. At least they maybe trust them a little, right? So that is also going to add up to your recognition criteria to make that decision. Number four is the creators. Find out about the individuals or organization behind the blockchain. For example, Bitcoin. Bitcoin theme is anonymous. We don't know exactly who created it, but the organization running Bitcoin we know is bitcoin.org. So at least Bitcoin is 50-50, but still Bitcoin is Bitcoin. You know, Bitcoin is not going anywhere. Point number five, is the coin sustainable? A coin worth investing in should solve a problem, and solving that problem should be the goal of the coin's creator and not just making money. It's very important. You should also take a look at the project's website, all right, and see if it looks legit, if it looks real, if it looks like they've really invested money into creating that website. All right, now you have to check their day's release and do some math on the market cap and circulating supply, and be sure that it makes sense, it tallies with the numbers you are seeing, and also the news. So the media hype is also very important. At least if Foop or Yahoo Finance or Cointelegraph, CoinMarketCap, Coinbase are writing about a certain cryptocurrency, it makes sense to also want to even read more and see if their project really makes sense. All right, now crypto white paper. A white paper is a document released by a crypto project that gives investors technical information about its concept and a roadmap for how it plans to grow and succeed. Now, this includes facts, diagrams, statistics, and quotes. The best white paper will be honest about why their solution needs the blockchain. For example, a white paper can state clearly that their blockchain is for token generation and some smart contract management. Straightforward. The white paper is more technically oriented. This is why a lot of people don't like to read white papers. They just look at top 50 coins on coinmarketcap.com and then they pick one and then they start putting money into it. Yes, you can do that, but it's good to try and read and understand. This is part of doing your due diligence, all right? Making your own research. Maximum of 25 pages or so or more. Like, even if it's 50 pages, come on, man, you're going to risk your money. Now, reading the white paper. Let's break it down. So the white paper will be broken down into the abstract, which is the summary, a summary of what you're about to read. Then the introduction that presents the problem and proposes a solution to the problem that has been presented. Then the technology aspect will give you details on what sort of tech backs this crypto. Now the transaction tech, how is crypto exchanged? The mining tech, how is this crypto mined? And then the network tech, how is information communicated within the network? All right, so all these you should read and try to understand on the white paper. Now, incentive. Why should you participate in this crypto network? Then we have the emission plan. So the emission plan will include how the creation of new coins or token be conducted. Then we have the conclusion, which review presented information, and then a reference which also include source and citation. All right, now to the right is the first page of the Bitcoin white paper. Now you can download the Bitcoin white paper from CoinMarketCap. When you click on Bitcoin, you're going to see the details, or you can just Google it, Bitcoin white paper, and then you're going to get it coming from many sources. But I am also going to break down the Bitcoin white paper to you in another video, so stay tuned on this channel. Now, crypto news. Now, news which is fundamental is one of the movers of the cryptocurrency market. So you always want to stay up to date with the news by checking out either coinmarketcap.com, coindesk.com, forbes.com, bitcoinist.com, cointelegraph.com, and etc. So these are a few of them that I do visit regularly, and not just here, even Yahoo Finance, investing.com, and a whole lot do write about cryptocurrencies. So you want to be up to date with the market by knowing which news is trending in the market. Okay guys, so up next is the initial coin offerings. This is an event where new cryptocurrencies are sold to raise capital to support the project. How to participate? You register through the project website. Get some Bitcoin or Ether. The minimum amount to invest can be found on the website or in the white paper of the project. Then you move the Bitcoin or Ether to your wallet, and then be sure that the wallet can support the ERC20 token standard, which is the Ethereum network. All right, and then you buy the ICO token by sending the crypto to their address. All right, risk involved. Now, because this crypto space is completely unregulated, anybody can decide they want to perform an ICO at any point in time. So you have to be careful which ICO or which project you are getting yourself involved in. Many ICOs have failed or turned out to be fraudulent. All right. Now, this is the more reason why I personally, it's hard for me to decide whether I want to do an ICO. And I think that I don't want to be greedy to go after a new project simply because of gains, right? Like you want to buy the coin from the ground up, right? There are other projects that did their ICO long ago, however, are doing very well, or they have promising future. So why not invest in those promising projects than a total new project? Some people out there just go like, yo man, there's a new coin, they want to buy from ground up because they had Bitcoin came and it was 0.0 something, and therefore it's currently 60k, so they want to buy a coin and next year it will be up. Now lie, it doesn't always turn out like that. Most of them turn out to be scams. Now, the strategies. Day trading. Day trading is a short-term trading strategy where the trader buys and sells a cryptocurrency within the same day by speculating on price. And this strategy relies heavily on volatility and liquidity, all right? So you want to see a lot of pump and dumps, a lot of moves to the upside, and then you get out, right? So that's what day traders are looking for. Now, day traders uses technical analysis, which is the chart, to determine when to buy and when to sell. Day trading is risky. You're going to face with severe losses and then extremely stressful and expensive. You will trade with margin, and margin we know is a double-edged sword, all right? Technical analysis is a method used to predict the probable future price movement of a cryptocurrency, even in forex or stock, using the chart. So it can be creative and dynamic, which helps you gain a very deep perspective into the asset, because you have to study the price movement. You have to follow where the price has come from and where you think it's going to go, what is influencing the price, right? So you are going to create a strategy around it and then trade with it. Now, investing. So investing is to buy and hold a cryptocurrency with the expectation of achieving an increase in value over a period of time. So even in investing, we have the short-term and long-term strategies, all right? So if you want to be an investor, you have to decide whether you want to be a short-term holder or a long-term holder. So short-term holder is like holding for less than a year. This way, if you're in the US, you're going to be paying short-term capital gains tax. And then if you're going to hold over a year, you're going to be paying long-term capital gains taxes. And then long-term, you're looking at 5 years, 10 years, or forever, for life, right? That is the type of holding. And normally in cryptos, you will see HODL instead of hold. It is not a mistake. It also means that hold on for dear life. So it is just a term within the cryptocurrency world, all right? So if you come into the crypto world, you'll be seeing terms like HODL or hodling. Okay, so this strategy, normally you want to use dollar cost averaging. It is less risky. It writes out short-term losses. It is stress-free, completely stress-free. And then no emotional roller coaster when trading this strategy. All right. Now, dollar cost averaging. Dollar cost averaging is an approach to investing that involves periodically investing an amount of money regardless of the market price of the cryptocurrency. No need timing the market. Helps you take the emotions out of investing. Now, this strategy compels you to stick to the plan. Reduce the impact of volatility and risk exposure. So this is dollar cost averaging for you. Now, the downside of this is that if the market goes up during a period of DCA, you might miss out on the potential gains you could have had if you invested a large amount right away, right? So it means that even though you had 10,000, you wanted to dollar cost average, right? And then you were doing it in bits. However, the market went up 100% or 1,000%. You deposited just a little of the total money you wanted to deposit. That seemed like a downside. However, it's not always gonna be the case. So you are likely gonna be on the safer side if you dollar cost averaging. So we'll be looking at more advantages to dollar cost averaging. Now, consistently buying cryptos during price declining periods means acquiring more cryptos at a cheaper rate than if price were higher. All right, so this is like an upside to the strategy. How much should you invest? Okay, so putting your entire life savings into Bitcoin or cryptos is probably not a great idea. Now, depending on your risk tolerance, it might make sense to allocate a portion of your portfolio. Most experts think you should allocate a maximum of 5% of your portfolio to cryptos. You can also consider diversifying your portfolio. Everything depends on you. how much you want to risk or how much you can afford to lose. All right. Now let's look at lump sum versus dollar cost averaging. So these two strategies are the most used strategies in investment. So let's look at these two strategies. Now here, Romeo has $1,000. Julie also has $1,000, and they both want to invest in H1Z coin. H1Z coin is a cryptocurrency. Okay, so in the first month of their investment, Romeo decided that he wants to apply the lump sum investment. So he invested $1,000 at a go. The value of the H1Z coin at the time was $1,000. So Romeo got one H1Z coin. Juliet wants to do a dollar cost averaging strategy. So Julie invested $100. So she got 0.1 H1Z coin. All right. Now the second month, H1Z coin had dropped from $1,000 per coin to $900 per coin. Now Romeo's portfolio is down to $900. And then Julie's portfolio, however, topped up another $100, but instead of being up $200, she's also down at $190. And this time, when Julie bought $100, she got 0.11 instead of the initial 0.10. It also means that if the coin value had gone up, she would have gotten lesser than 0.10. All right. Now that the market has dropped, your portfolio is likely going to drop because you're already holding a coin and then the value has gone down. All right. So Romeo still in the next month couldn't add up because he did a lump sum. The coin value has dropped to 800. Now Julie got 0.13. Again, she's getting more coins while the market is on a downtrend. Although her portfolio has gone down. So instead of $300, she's now got $270 because the coin value is going down. The following month, the coin value is down again at $700. But Julie understands the strategy and understands that she wants to do this for a very long time. So even in the 4 months period that the coin value is going down, Julie is not giving up. She keeps buying, and every time she buys, she gets more coins. Although her total invested fund keeps dropping. It means she's now focusing on the money, but the coins. Okay. The next month, H1Z coin had dropped to $600 per coin. So you can see in Romeo's portfolio that the portfolio is shrinking. The $1,000 is now $600. Now, Julie's portfolio is also sitting at $400 instead of probably $500. However, we understand that the coin value is shrinking. Now, the next month, the coin value has dropped again, and this time Julie got 0.2 for a $100 purchase. The next time it dropped again to $400. Julie got 0.25. Another drop, and this month Julie got 0.33 at a $100 purchase. Romeo got nothing because he's not buying. However, Romeo's portfolio is also down to $300. But Julie's portfolio is up. Even though Julie has only invested $800, you can see that Julie is now having $520. Seeing your portfolio shrink is not really something to worry about. Okay, I know a lot of investors panic once their portfolio is going down. Focus on the coins. Now look at something. Julie, although has not invested $1,000. She's got more coins than Romeo, because at this point Julie has 1.42 H1Z coins. However, Romeo has just one H1Z coin. Okay, let's look at the next month. The next month, Julie bought $100 and still got more than the previous month, which is 0.5. Wow. Now, the final month, the H1Z coin value was down to $100. $100 per coin. Romeo's portfolio is now worth $100 because one H1Z coin is equal to $100. Now, Julie has got $100 left, and then she buys another $100 to her portfolio, and she got one H1Z coin. So she now has a total of 2.92 H1Z coins. Now she has invested $1,000. But look, her portfolio is $550. Yet Romeo, who did the first purchase at $1,000, has his portfolio sitting at just $100. All right. Now, on this chart, you can see when Romeo and Juliet bought the coins. So Romeo bought one time, which is the green arrow, and then Julie has the pink arrow on all the 10 times she made a purchase. Now, what happened after the October month? The coin started to go up. H1Z coin now rose and went beyond $1,000 and $2,000 per coin. Now, let's see. Romeo acquired a total of one H1Z coin, and then Juliet acquired a total of 2.92 H1Z coins. Now, if H1Z coin value goes up to $1,000 per coin, it means that Romeo's portfolio will now be worth $1,000, and Julie's portfolio will now be worth $2,920. If the H1Z coin continue to go up to $2,000, Romeo's portfolio will now be worth $2,000, whereas Julie's portfolio will now be worth $5,840. It is simply multiplying the amount of coins you have by the value of the coin. So let's say H1Z coin went up to $3,000 in the near future. Romeo has made profit, yes, because his portfolio is now sitting up at $3,000. But let's check out dollar cost averaging Lady Julie. Her portfolio will be sitting up at $8,760. Wow. That is a big advantage of dollar cost averaging. All right. Now, how to get started on crypto investments? Open an account. So you open an account with Binance or Coinbase and etc. All right, so please support the channel by using the link in the description. And after signing up, providing your personal information, then you get verified. The exchange will require you send them a photo ID, or you take a selfie and etc. to verify your account. So once you verify your account, you will not be restricted on how much you can transact within a day and etc. All right. Now you found your account, so you can deposit money from your bank account onto your exchange. Now it depends on which exchange you are using and your jurisdiction. All right. So for example, if you are in Ghana, you cannot use your bank. Most of the banks in Ghana does not support depositing money onto a crypto exchange, so you have to take note. You can deposit Bitcoin or other cryptocurrencies onto your account. All right. Now you can buy Bitcoin, USDT, or other cryptocurrencies from h1zmarket.com. All right. Do your due diligence. So you choose a coin, but research and understand what you are investing your money into. This is very important. We've already looked at how to do a due diligence, how to research on a coin, how to analyze a coin before you invest in. All right. Now, purchase the coin you want to buy and hold. So pick wisely and only invest what you can afford to lose. In conclusion, cryptocurrencies over the last 13 years has truly disrupted the world's economy and financial system by providing a payment system that is ahead of its time. Cryptocurrencies, or the blockchain technology, according to many experts, is revolutionary, and the best is yet to come. Now, according to Tyler Winklevoss, a co-creator of Facebook, we have elected to put our money and faith in a mathematical framework that is free of politics and human error. According to Rick Falving, founder of the Swedish Pirate Party, he said, Bitcoin will do to the banks what email did to the postal industry. And finally, John McAfee, founder of McAfee, also said, you can't stop things like Bitcoin. It will be everywhere and the world will have to readjust. Alright guys, thank you for taking the time to watch this video. I know this was a long ride, but thank you very much for your time, and I know that you've gotten value from this. Please like this video and subscribe to the channel for more videos like this. If you have any question on any topic, please write it in the comment section, because I am going to read it and answer you with a detailed explanation. And if necessary, I will do a complete whole video for you. Also join our Telegram channel for more free tips on cryptocurrencies and forex trading. Link in the description. See you guys.